In the world of finance, there are only two things we can be confident of: your current financial situation and the fact that your life will change. That's all. Anyone who tells you otherwise is deceiving you. You can't forecast or even plan for an uncertain future, no matter how hard you try. All you can do is use what you know to your advantage. Traditional planning assumes that your life, your future, is linear. It then attempts to construct a foolproof plan for success by using stationary inputs and predictions about the future. The bad news is that your life isn't a straight line. It is not static. If you plotted your life up to this point on a graph, you wouldn't get a perfectly straight line. That's because things happen, and when they do, they can tip your life in one direction or the other. Your life is constantly in motion, evolving over time. Because it is dynamic, it cannot be addressed by a static plan. That is precisely the issue in traditional planning. So, what should you do now? How do you assure that you can deal with life when it comes your way? You follow the following three principles. 1. Spend less than you earn. One of the most fundamental rules for achieving financial success is to spend less than you make. This sounds simple enough, but in practice it can be difficult. Let's examine the obstacles of spending less than you earn and provide some solutions. I'd like to start with people who spend more money than they earn. It follows that if someone spends more than they earn, they are either being handed money or borrowing it. Borrowing money has never been easier in this age of global economic progress and wealth. Borrowing is omnipresent, whether it's for a new TV, a new car, or a new house. Personal debt levels in Australia are at an all-time high. According to the U.S. Federal Reserve, more than 40% of U.S. families spend more than they make. Personal debt has the potential to become a trap. Credit cards, maybe the most widespread kind of debt, are an illustration of how one might become imprisoned by it. To avoid incurring interest, consumers should pay off their debt in full at the conclusion of the interest-free term. However, most people exhaust their whole credit limit and just make the minimum payment required. This minimal payment is typically insufficient to meet the interest costs. Credit cards are an expensive method of borrowing when combined with high interest rates. There are also some whose spending equals their earnings. If someone spends everything they earn, they are obviously not saving or investing any of their profits. This behavior will make it extremely difficult, if not impossible, for them to become affluent. It also implies that they will almost certainly need to borrow money in the future to finance larger purchases or holidays, and thus the financial trap begins. How can we thus spend less than we earn? Method 1. Develop financial intelligence and discipline. Method 2. Lower consumption. The ideal way to combine these two methods, financial discipline and limited consumption, is to create and stick to a budget. A budget is essentially a plan that divides your future earnings between expenses, savings, and debt payments. If you dislike the thought of making a budget, pay yourself first is a brilliant technique to ensure you spend less than you make. You may relax knowing that you are spending less than you earn if you set up an automatic method to pay yourself first and avoid paying for things and services with credit. 2. Make the money you have work for you. First, what exactly does it mean to put your money to work for you? Making money work for you includes gaining control of your finances and consistently utilizing that power to improve your stability and security. You may eventually be able to achieve financial independence or accumulate wealth through investment, but none of that can happen until you understand where your money is going and how to spend it more wisely. You may put your money to work for you by doing the following. Avoid debts. Again, when you have debt, you must pay more than the original purchase price. In addition, you must pay interest, which can considerably diminish your income. When you are in debt, your money is not working for you. Instead, it is being used to pay interest. It restricts your options and places a financial strain on you. When you pay off your debt, you may use that money to fund the things that are important to you. You can use it for other financial goals such as education savings, retirement planning, vacations, or home improvements. You could start your own business. You can begin investing in it and expand your wealth and produce more financial independence. Purchase real estate. Investing in real estate is a wonderful way to put your money to work for you, but only if you have enough money to put down. The advantage of owning real estate is that you have complete control over how you earn from it. It can be rented out, improved for sale, increased in value to increase rentals, and so on. You don't want to miss it, believe me. Invest in the stock market. Your best choice is to invest in the stock market by buying individual ETFs, exchange-traded funds, and mutual funds in a model portfolio if you want to grow your money truly. For example, if you start with $10,000, save $1,000 per month and invest it in a 10% yielding portfolio. After 30 years, you will have $2.3 million. Create a high-yielding savings account. If you retain your money in traditional savings accounts, you will miss out on interest. The high-yield savings account, which performs the same functions as a standard savings account but offers a greater annual percentage rate of return, is now accessible. Even if you have to pay taxes on the interest, it will almost certainly generate more money than a regular account. Furthermore, because there's a limit on the amount of withdrawals you may make, you are less inclined to spend that money. 3. Plan for the unexpected. If the last 2 years have taught us anything, it's that unexpected, even unfathomable events occur and can have far-reaching consequences in our financial lives. While none of us expected to be negotiating the various obstacles that come with a global epidemic a few years ago, the truth is that the unexpected occurrences, big and little, are a frequent part of life. It is also critical to plan financially for unexpected expenses. In terms of personal money, we all need to grasp how critical it is to plan for possible unforeseen expenses. Failure to do so may jeopardize your capacity to meet your short and long-term financial objectives. Understanding the universe of unknown events that could affect your financial health is the first step toward limiting the risks of unexpected spending. The second stage is to prepare as thoroughly as possible. COVID-19, according to Dan Herron, a principal of Elemental Wealth Advisors in San Luis Obispo, California, has been a stress test for people's money. One key shift we can all make is to accept that unexpected costs, both large and small, may occur, and then take activities such as the ones we will discuss next to prepare for them. Create an emergency fund. Herron argues that before COVID-19, the normal emergency fund was designed to cover a family's costs for 3 to 6 months. Financial experts differ on how much people should save for unforeseen expenses, but most recommend setting up automatic contributions each paycheck into separate accounts designated solely for emergencies. Savings will accumulate without your intervention, and the money will not be mixed in with other accounts you use to pay your payments. Take out an insurance policy. Having adequate insurance, such as home, car, health, and life insurance, is a key component of any plan to cover unforeseen costs. According to eHealth, the average cost of a health insurance policy for a single individual is $462 and $1,437 for a family of 4. While this is not a small expense, it is considerably preferable than having to come up with tens of thousands of dollars to cover an ER visit or a major sickness such as cancer. Life insurance is especially vital for those who have dependents on their income. Budgeting and credit. Using credit responsibly can help with budgeting because reading monthly statements can help identify spending that can be cut in order to preserve money for unforeseen needs. It may seem strange to say, but you should expect unexpected charges in your life, and you won't be able to prepare for them after the fact. So make your emergency plan now so you're ready for the next time. Your success is not determined by your financial situation. You can have all the money in the world, but it means nothing if it can be wiped out if your circumstances change. Rather, your success is determined by your capacity to effectively respond to life as it unfolds around you. Whether your tactics can adjust to your current financial situation as it evolves. I hope you learned something valuable. If you want to learn more such amazing things, all you have to do is like the video, hit the subscribe button, and press the bell icon so you don't miss anything new from us.